Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. We're going to rip through Twitter today, see what people are sharing on social media. I'm going to interject my financial opinions. It'll be related to a couple of topics, usually wealth building, financial topics, or commodity related things. Let's dive in, see what's going on and what people are talking about. And again, at finding_finance if you want to follow me on Twitter. And you can check out our community at finding-value.com, where I go over individual companies and you can see my portfolio. You can see what I'm purchasing, when I'm purchasing it, why. I generally say why I'm buying something. You can see the technical analysis behind all of those individual companies during the midweek updates that I give, which comes out Wednesday tomorrow. All right, so let's see what's going on here, guys. So we've got this guy, Benjamin Deutsch. He says, copper. This is from the CEO of Glencore. The world just doesn't get it. It doesn't understand that a massive copper deficit is coming, said Glencore CEO Gary Nagle. The world will stop without the additional copper supply, but the price of copper is not expecting it. So the price of copper right now is not expecting a massive copper deficit that is coming. Get ready, guys. And you know, this is the opportunity that people have to buy commodities. Why is there an opportunity? How come the market isn't pricing this? I don't know. Neither does Glencore's CEO. He can't figure it out. Neither can Robert Friedland when you listen to him talk about copper. It's like, dude, there's a big deficit coming in copper that is basically almost unstoppable. That's using their words. So I don't know. I mean, I've got investments in it. I'm just going to sit in it and wait. And this is the S&P 500 in relationship to this is GSCI, which is the commodity index. The index is sitting down here in no man's land. No man's land, guys. It's cheap. It's undervalued. It's just being given away. And, you know, when I zoom in, that's that big pull up and the pullback, and we're starting to move on up again. There was a pretty long sideways move in the 1960s and 70s in commodities. And I know some people say, well, what if you have to sit in it for 4 or 5 years? Okay, I will sit in it for 4 or 5 years. And guess what came? When you sat in it from the 60s all the way and it blew up in the 70s here, you know how much money you make from circle to circle here? You know how many multiples of your return you would gain during that time frame? I don't think people understand. Sitting for a 20 bagger for 5 years is not lost time. You're not going to beat that in the markets, guys. There's very few people in the world that have beaten those types of returns. And I don't even know if Buffett and those guys have beaten the returns if you could swap accurately enough and wait during these time frames. He just has too much money. He can't go in these small mid-cap companies. He can't do it anymore. He's too big. He's got to go buy the big boys. And your returns are going to be muted. Now here's this. A picture says more than 1,000 words. Time reveals the true value of all fiat currencies in the long run. Gold and various currencies measured in gold from 1900 to 2023. This is 100 where the starting point is, where they have full value of the currency. These are a bunch of different currencies. Some of them are the mark, the Reichsmark, Japanese yen, Great Britain's pound, etc., etc. Where do they all go? To zero. They all go to zero. So saving in fiat currencies, bad idea. You only want to have enough fiat currency for whatever expenses that you have. Then you want to look at investing. That's how you preserve your purchasing power and your wealth over time. You can't save fiat currency. You have to save in something else. It could be gold. And what he has here, this 100 is gold. Gold's preserved your power. Everything else just goes to zero against it. Someone also asked me, could I answer a question about a comment that somebody made about gold? Gold is the measuring stick of the monetary, the measuring stick of it does two things. Okay, it's the measuring stick of money in the system uh, under certain market conditions, and gold goes up with the rest of the commodities. So they don't want gold. They, being the Federal Reserve, the governments don't want gold to go up because what it's going to do is it's going to reprice the entire commodity sectors all higher because they all move under a certain market condition. When gold moves up under certain market conditions, the rest of the commodity group follows with it. So gold bull markets occur under commodity bull markets. And someone said, why are they so worried about gold moving higher? Because gold is going to reprice the entire commodity complex and all other precious metals and everything with it. And what happens is money can be created during certain periods of time, and you don't see it in the consumer price index because it's not in the right market conditions for gold to basically account for the currency in the system. We are coming into a period where the currency is going to get accounted for by gold, and it's going to price commodities vastly higher, which will eventually see inflation in the consumer price index, which the governments and Federal Reserves do not want to happen. It's going to put pressure on living expenses, and it's going to put pressure on people voting and all that other stuff. They don't want any of it. The uranium bull market is just getting started, but it could get completely out of hand before it's over. And this is Adam Rosenswag, and he talks about $300 per pound. I think he's being conservative because he doesn't want to come out as a kook and say, maybe it goes to 600 or 700 or 1,000. Cuppy's come out and said, who knows where it's going to go? It could go to $1,000 a pound. I'm in agreement. I don't think you can. The people who have responses. I'm sorry, guys, but this is just a horrible response. They're like, well, uranium can come from seawater at $200 a pound. I'm like, oh, really? So in T minus 6 months, if someone panics, if everyone panics, whether that be the utilities or financial players, that because we can get uranium out of seawater at $200 a pound, which we probably can't, but let's just say we can, that magically it's going to show up in 6 months? No, the people are going to panic because to get uranium, there's going to be a window where it's going to be tough to obtain it. And that is where people will panic. It's not, uranium went to 140, 150 last bull market, and we had a surplus of uranium. We had a surplus. That was like the threat of a deficit. Can you imagine if deficits are actually seen in the market? Where someone said, you know what, I went out and I couldn't buy it within 3 or 4 days of trying. And then someone's going to panic. And when they panic, that's when the price will move. It has nothing to do with the break-even costs of anything to do with uranium. It has everything to do with the lead times of the market to bring on new supply. And there could be a gap where people panic. That is where the price could go ballistic because there's nothing to really absorb the panic dollars with. There's no physical absorption. So if people said, okay, I'm going to bid $100 and you get no bid, $200, no bid, $300, no bid, $400, no bid. Okay, well, where's the bid at? Maybe there is no bid. So what's the price supposed to be? I don't know. And I don't know if it's going to get to that type of scenario, but some of these guys say it could get completely out of hand, and that's the reason why. I don't know if that's necessarily going to be the case, but that could be the reason why. Here's Grady. The inverse correlation gold versus USD can be strong shorter term, but in the longer term, it's not an issue. This chart fits well with the USD most probably has topped for good. As said, we called the USD top back in September of 2022. And you can see that the pattern in the consolidation of 80 all the way up to about 2000, early 2000s, is the same pattern. It's just an ABC type correction, not technically ABC, but we've got a couple of humps here that we're about to break on gold. Now, I know some people are saying, well, it hasn't done it yet. Of course, it hasn't done it yet. Like, calm down. It's coming. That's what we should be watching this as a break. And again, when this breaks, it's going to be a very big move. Eric says oil falls more than $2 on weak demand fears quotes. There is no, this is real time demand and they're all higher. All the demand is higher. So it's not demand driven. I think Eric really focuses a lot on supply and demand and not so much on liquidity in the system and dollars in the system and interest rates. They also have an impact on the financial side. So I understand the supply demand side of it. I get it, Eric. But there's also the financial side that pukes it sometimes. We're just going through a little bit of a lull before, I think, a move higher for oil. Now here's gold. So gold is a safe haven and copper a base metal that does well in good economic conditions. They call it Dr. Copper. See what happened during the inflationary 70s. Coming move will dwarf the 70s by a mile. Chart now has a pink double bottom breakout and new high after a back test of a shoulder head shoulder, double bottom and breakout of the back test. This is copper, gold versus copper, gold versus copper. So gold is going to outperform copper coming up here. It's a safe haven asset. People are going to run into gold for whatever reason it is, the inflationary 70s. So again, this is the big move with an increasing interest rate environment here. This consolidation is your decline in interest rates for the 40 years. That's how I view this. Peak yields happened in 80, 81, and then they came all the way back down. And guess what's happening today? Yields are shooting higher. And guess what that's going to do? It's going to rotate money out of bonds. It's going to rotate money out of stocks, and it needs to find a home. And gold, under those market conditions, is the home that you're looking for. So you're going to see, I think, a big move, guys. And it's not going to have this might not happen immediately. That's what is going to throw people off. It's going to happen within the next 6 months, year, 2 years, whatever it is. And the move's going to be big. It's going to blow your socks off. Why is that? Because people are going to be they're not going to be happy that bonds aren't going up. They're not going to be happy that stocks are going sideways. So they're going to chase performance. And if gold, which is sitting on top of its pattern right now, starts to break, they're going to chase. And maybe Bitcoin even goes up. I don't know. Bitcoin could do it, and gold. Maybe they run together. Maybe they don't. I don't know the market conditions where Bitcoin will be an all-star performer. We haven't seen it through the many cycles. It's never been in an upward interest rate environment, but gold has, and gold has performed very well along with silver and platinum. They're all going to crush it. A global asset paradigm shift is in the making, away from equities, bonds, USD. He knows it. This dude knows it. Grady has his SHIT together. Super high intensity training, guys. Towards tangible assets. This ratio has yet to break out on a daily chart, but here on a monthly line chart, it has broken out and is back testing. The tide is surely turning, and these things take time, guys. The most confusing time in all of these areas is the turning points that you get. All these turning points are the most confusing times because you're going to get data that supports and negates your thesis or your emotional how can I say it? Whatever you're using to validate that you're right or wrong using prices is going to be back and forth at bottoms and tops because they go up and down. So you're going to say, I'm right in 2021, 2022, and then I'm wrong. Oh, I'm right, then I'm wrong. And then you're going to start to question the trade. How come this isn't working out? How come it's not going anywhere? It's because we are transitioning. We're in the middle of a large transition where it takes years to transition. Your time frame is too short. You can't do this in weeks. You can't do this in months. You have to look at it in years. And when you take these big patterns and they're starting to break and start to grind out these bottoms and move up, it starts really slow and it's really annoying in the beginning. Then all of a sudden it starts to pick up speed. Then all of a sudden your account starts adding zeros. That's what occurs. It just takes time and it takes patience. This is like building up to an 800-pound deadlift. You're not going to do it overnight. It's going to take a decade to get there, and probably a lot of steroids for most people. So this is going to take time, guys. It's going to take time. Again, gold and silver miners still below a long-term trend line, downtrend line. There's the downtrend line. We want to break this for quote happiness. Says, I know, I want them to break out too, just like everyone else. I'm just like everyone else. All right, I want it to break. I want to buy the crap out of it. Trust me. I've been leaking money in. I've been buying, here and there, leaking, doing. I call it sprinkling money in. And I think the opportunities here, when we break, I'm going to pump it, hit it again, pump it again. Here's gold futures. So this is the gold price. So we're still stuck between the miners. Gold and silver miners are still stuck underneath the downtrend. But the physical metal futures pricing, gold is sitting atop of support. This is a good spot to be for a move higher over the medium to long term. In the short term, we could still go sideways or slightly lower, but gold's looking awfully good. It's looking awfully good. Bitcoin fractal looking similar to the last bottoming pattern. Look at that fractal I grabbed and put it overlaid. It looks very similar, as like a liquidity cycle could be coming or something. A couple of videos. It says it's very simple. For this guy's opinion, he says rates will come down. If FFR stays even near 5%, the national debt will hit 40 trillion by year of end, 2025. Interest expense would then be 2 trillion. 45% of all federal tax revenue. Whether by will or if a recession war forces them first, rates will come down, in this person's opinion. I don't know if they will, guys. I don't know. The problem is if rates go down, the dollar is going to drop like a rock. Powell can't lower rates without the dollar falling massively. So he's pinned in a corner where he has to raise rates to basically preserve the purchasing power of the currency that gives him all the power and control. And then he doesn't want to lower rates because inflation will come from the real estate market if he lowers them far enough. So he's pinned into a corner where if he lowers rates, the dollar will drop and more inflation will come from fractional reserve lending in the commercial banking system. That is also why we have a Livermore accumulation cylinder in KRE, in my opinion. So yes, he's stuck between bankrupting the government and lowering rates where they don't bankrupt him, but he sacrifices the currency. I don't know what he's going to do here, guys. He's kind of screwed either way he goes. And right now he's trying to buy time. David says the next commodity surge has commenced. We believe that the commodity sector is now at the start of one of the biggest rallies in 56 years with an expected peak of 25-27. Here's Lynn. She says a lot of people point out that historically the uninversion of the yield curve is the imminent recession signal. But keep in mind that it's usually because the Fed is cutting the short end, not because the long end is exploding higher. Does that make sense, guys? The way that this curve's uninverting is the long end is moving up. The short end is staying still, higher for longer. Usually before a crash, the Fed cuts the short end of the curve, and the curve uninverts from the short end, not from the long end exploding higher. So that is something that I think I talked about that in one of the question and answer sessions. And I still, you can't see by looking at some of these charts what the uninversion is, but the majority of the uninversion before crashes have been from the short end dropping. That is a true statement. Tavi says, for what's worth, the top 7 largest tech stocks are currently staring down from a scary double top technical formation. My 2 cents, either interest rates must decline drastically from current levels, or the valuations among these stocks are primed for a meaningful reappraisal. I think we're going to head potentially lower or sideways, is my guess. And it's going to be spurred by an increase in interest rates. Increased interest rates, growth stocks are usually go down. But I will say the Magnificent Seven, they are cash flow generating machines, so they may behave a little bit different. This is important. Zoltan believes the Fed will be forced to announce yield curve control by year end. And maybe that's why we're seeing Bitcoin and gold positioned where they are. Could be. So Zoltan believes the Fed will be forced to do yield curve control. That's what he says. Just as war is becoming more entrenched as a macro theme, the Fed continues to do QT, and so it does the precise opposite of war finance. In commodity choke points and QT, I noted that the Fed would have to restart QE sometime during the summer of 2023, and according to page 6, the amount of government debt that will need to be absorbed by the private sector in 2023 is larger than at any time outside of wars. And that's what's going to drive, in his opinion. And we'll see if that occurs. Copy says, as an investor and trader, I know the relative strength during big down days is the most powerful signal in a market. Strength leads to strength. Fund flows chase green. Uranium is screaming at investors to pay attention. Yes, it is. And it's also got good patterns that just broke to the upside. He looks like a Wolverine, kind of. All week, I was amazed at how strong uranium was, while most other CUSIPs were in meltdown. Physical kept upticking. Spot even had a bid. Think that the panic starts on Wednesday when NEI ends and the 7 guys with 7-fig RFPs for December realize that there's no offers available. That's when the panic could potentially start. Patrick says, end of an era for U.S. stocks when priced against 10-year yields, and they're falling. Big era from 82 all the way back down. Stocks outperformed yields, and here we are coming the opposite direction. This is the market. This is the paradigm shift that's coming here, guys. And that's where I'm going to end it. So that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you guys like. Discounts, coupon code. What's coming up this next week, 7 a.m. Mountain Standard Time on Saturday for our question and answer session, if you guys are interested. But that's what I've got for today, guys. Everything looks good on the commodity side. Everything looks good that other people think as well, and a lot of gold bulls out there. All right, guys. We'll catch you later. This is Finding Value.